Welcome to today's live trading session. I'm excited to have you here as we dive into another action-packed day of trading. In this session, I'll be using two powerful tools, the EMA Exponential Moving Average and Heikin Ashi candles, to identify high-probability trade setups. The EMA helps us track market trends with precision, smoothing out price fluctuations to reveal the true momentum. Meanwhile, the Heikin Ashi indicator provides a clearer view of price direction by filtering out noise and highlighting strong trends. When combined, these two indicators create a robust strategy for spotting profitable trades with confidence. To begin, I'll be adding two exponential moving averages EMAs to our chart. These EMAs will help us identify key trends, spot potential trade entries, and refine our strategy for maximum accuracy. First, I'll select an EMA indicator from the list. I'll change its length to 20 so that it captures short-term trends effectively. Next, I'll set its source to high. This means the EMA will be calculated based on the high prices of candles rather than the closing price. To make it visually distinct, I'll change its color to green and increase its thickness so it stands out clearly on the chart. To differentiate it from the first EMA, I'll set its color to red and increase its thickness for better visibility. I'll set its length to 20 as well, keeping both indicators in sync. This time, I'll change its source to low, which means it will be calculated based on the low prices of candles. With these two EMAs in place, we now have a dynamic price channel that helps us gauge market direction, detect breakouts, and identify strong momentum shifts. To make our price action easier to read and filter out unnecessary noise, we'll be switching our candlestick type to Heikin Ashi. This simple change can significantly improve how we analyze trends and spot potential trade setups. Unlike traditional candlesticks, which can be choppy and sometimes misleading, Heikin Ashi candles are designed to smooth out market fluctuations. With this setup, we are now ready to analyze the market with precision and take well-calculated trades. Stay tuned as we dive deeper into how to use Heikin Ashi with EMAs for profitable entries and exits. The concept is simple. We take a trade whenever a Heikin Ashi candle moves outside the 20 EMA channel. The EMAs act as dynamic support and resistance levels, helping us determine entry and exit points with precision. First, we observe a red Heikin Ashi candle crossing below the red EMA 20 low. This signals a potential downtrend, indicating that sellers are in control. As soon as this happens, we can enter a short trade, sell position. We stay in the trade until a new candle closes above the red EMA, signaling an exit. If you've been looking for a straightforward way to identify high-probability trades, this setup is perfect for you. Using just Heikin Ashi candles and two 20-period EMAs, we can effectively catch trends and maximize our trading potential. We take a buy trade, long position, whenever a green Heikin Ashi candle moves outside the 20 EMA channel, signaling that buyers are stepping in with strong momentum. First, we wait for a green Heikin Ashi candle to cross above the green EMA, 20 high. This breakout above the EMA signals that buyers are in control and an uptrend may be starting. As soon as we see this confirmation, we enter a long trade, buy position. We stay in the trade until a candle closes back below the green EMA, signaling an exit. With this approach, you can confidently catch strong bullish trends and maximize your gains. Ready to see this in action? Let's move to live charts and analyze some real trade setups. This is something I emphasize in every single trading session. Never take a trade when the EMAs are flat and moving sideways. It's one of the biggest mistakes traders make, and it can lead to unnecessary losses. When the 20 EMAs are flat and moving horizontally, it means the market is lacking momentum. This is a sign of consolidation or ranging price action, where price moves up and down within a small range without a clear trend. In this type of market, trades become unpredictable and can easily hit stop-loss levels. Here's the secret. The big move comes after the flat market. After a period of consolidation, the market often explodes into a strong trend, either up or down. This is the moment when smart traders position themselves for big profits by catching the breakout. Watch for a strong breakout candle moving outside the 20 EMA zone. Jump in at the right time and ride the trend for bigger profits. Now, here's where things get exciting. Look closely at the chart. You can see that the candle has crossed below the 20 EMA, signaling a potential selling opportunity. But before jumping into the trade, there's something very important to analyze. Not all candles are created equal. The size of the candle and the length of its shadow tell us a lot about the strength of the move. Here's what we need to look for. Big candle body, small shadow. This indicates a strong trend with clear momentum in one direction. Sellers, in this case, are in control, pushing the price down aggressively. The smaller the shadow, the stronger the conviction behind the move. Since this candle has a large body and a small shadow, it confirms strong selling pressure. The market is moving decisively in a downward direction, and that's the perfect confirmation to enter a short position sell trade. This is the kind of setup we wait for. Strong, clear signals lead to high probability trades and better profit potential. So if you see a flat market, don't force trades, just wait. The real money is made when the market finally decides its direction. Our exit rule is simple. We will stay in the trade until the price moves back above the 20 EMA. This keeps us in the trade as long as the downtrend is intact and helps us capture the maximum possible profit. As long as the price stays below the 20 EMA, the trend is still strong. Many traders panic and exit too soon, but by following the EMA, we stay in the trade until the real trend shift happens. Instead of taking quick, small gains, we let the market do the heavy lifting and maximize our profits. At this point, price is approaching a critical level plunge, and I can see signs that it might be trying to shift momentum. If the price touches the EMA and pulls back again, it confirms that the downtrend is still strong, and I'll hold the trade for more potential profit. If the price breaks above the EMA with strong momentum, that could be my signal to exit and lock in profits before the market reverses. Right now, I'm still in the trade and will continue to monitor price action. I expect the price to test the EMA level. If it rejects, that could mean another opportunity to ride the downtrend further. If the price breaks and closes above the EMA, I'll take that as my exit signal and secure my profits. Right now, I've noticed something crucial. The EMAs have become flat, and that's a clear signal of market uncertainty. When the 20 EMAs stop sloping and start moving sideways, it means that the market's losing momentum and entering a range-bound phase. This can be dangerous because the trend might be weakening and price could reverse. Market indecision means higher chances of choppy price action. Staying in the trade too long could eat into my profits. Since I always trade with a disciplined, rule-based approach, I've decided to close the trade and lock in my profit of $1,000. Now that I've exited this trade with a solid profit, I'll wait patiently for the next strong setup. Trading is all about making the right moves at the right time, and sometimes the smartest move is to step aside and let the market reveal its next big opportunity. That's it for this video. If you found this helpful, make sure to subscribe, like, share, and drop a comment below. Let me know your thoughts, and if you have any questions, I'd love to hear from you. See you in the next one. Happy trading.